Hey everyone, today we are going to talk about dealer positioning, which is a very interesting subject, and I'm very excited to go through all the charts with you guys. If you want to go to dealer positioning, just go to the options dashboard, go down, and then you'll see a section on dealer positioning. I've spent countless hours of the last month, one, trying to understand what dealer positioning is and how to actually leverage it as retail traders, and then second, just building out the charts that we are going to discuss today. Before we do that, let's just recap some of the simple Greeks. So we have delta, which is the change in the options contract price with 1% change in the underlying stock price. Then we have gamma, which is the change in delta with a 1% change in the underlying stock price. Then we have theta, which is change in the price of the contract, options contract, with each day passing. And then we have vega, which is change in the price of the options contract with 1% implied volatility move. And so these are the four simple Greeks that most people are aware of. Delta, sometimes people describe it as the probability that the contract will go in the money. That's a simple way to think about it. So a contract that is closer to the stock price, where the strike is closer to the stock price, would have a higher delta versus a contract that is farther out, where the strike price is farther out from the stock price. And I am just talking about the out of the money contracts here. So with that out of the way, let's talk about dealers. So there are many fund managers, and there are many smart people in this world that spend a lot of their time on the other side. They're market makers, and they have big funds, and they have access to huge flows. So it's somewhat easier for them to build out these massive sort of flows and build out these massive data sets as to what's happening on the options market. But I haven't seen any platform sort of do a good job of trying to understand what's happening on both sides, on the retail trader side, or on the sort of institutions that are buying or selling options, but then on the market maker side and the dealer side that are providing liquidity to all the flow traders. So we are going to try to talk about both sides here. I think that at least one side is always missing when we are dealing with sort of what retail traders do and how do we understand options flow. So to start with, let's talk about what happens when you buy a call. When you buy a call has a positive delta, and when you buy a call, someone has to sell you that call. It's typically the dealer or a dealer that sells you that call. So when you are buying a call, you are bullish, but the market maker or the dealer has to sell you that call, which means now they are on the opposite side, so they are bearish. But they do not want to be they do not want to have a direction in the market. They always want to stay direction neutral, so they want to stay neutral in the market. How do they stay neutral? They have a strategy called delta hedging, where if they have sold us a call and now they're bearish, they're going to buy shares of the underlying that is equal to the amount of the delta in order to hedge that position. So now anytime price moves up or down, let's say the price moves up, since they have sold that call, their contract is going to decrease in value. But since they have bought shares equal to the amount of the delta, those shares are going to offset the loss that's going to happen with their sold call position. And so they are again always delta neutral. But we have gamma as well. So when price moves 1% up, delta is going to change because we have the underlying gamma. So if delta was 0.5 previously, price moved 1% up, and gamma was 0.1. Now the new delta is going to be 0.6. Now that means these dealers are going to have to hedge again, and that's what's called dynamic hedging. So there are so many concepts that we're going to talk about. I'd highly recommend just like googling some of these and posting questions in comments and just sort of engaging in a discussion to understand sort of what's really happening in the entire market. So now we have established that the dealer does need to hedge dynamically. Now what happens when these contracts are about to expire? That's a very interesting part, because let's say a dealer had bought a lot of shares because retail was buying many calls, and they were short calls, which meant they had to buy many shares. I'm talking about dealers. Now when those contracts are going to expire, those dealers, again, they want to stay delta neutral. They don't really want to have a direction. They are going to sell all of the shares that they bought, and that can cause a slight bearish pressure on the market, especially for that stock. Now that these are some very basic examples on what happens. So let's say like a million people bought calls that forced dealers for that, like at that point, let's talk about GameStop and AMC. When people are buying massive amounts of calls, at that point dealers have to buy the underlying shares, and that can cause a momentum effect because retail is buying calls, they're expecting the price to go up, but then the dealers are actually helping them push the price upwards, because in order to hedge they have to buy shares when retail is buying calls. That's pretty interesting. The first time I learned it, it seemed very interesting to me on the idea that call buying actually pushes the price upwards. If like there is massive call buying, it's pretty interesting. And like why does that happen? Most people think call buying pushes price upwards, but why? Understanding the dealer side helps us know why that happens. Okay, but now let's say that all of those calls are expiring in a week, and let's say on Friday market is not moving much, so most of those people are, let's say, out of their calls, or let's say those calls are expiring. Now all of those millions of shares that the dealers and or market makers had bought, they are going to dump those shares. And that, since like at the time of buying all these calls there was a lot of bullish momentum, now when they are dumping, the dealers are dumping all of their shares, that can slightly cause a bearish momentum in the market or in that stock. At the time of trading these options, they are supporting you, but once they have built a position, they are going to keep hedging that position until expiration, and then at expiration, let's assume whatever they have left, they are going to exit out of that position. Let's keep this scenario in mind, because now we are going to talk about dealer positioning. So that's just, we were talking about calls. We didn't talk about bought calls, sold positions, sold puts, bought puts. So what if we were to aggregate every single contract that was bought or sold, whether call, whether put, and we looked at the impact of that trade on the dealers? Because if we know what the dealers are doing, then that might give us some idea on what they might do if price makes certain moves. So for instance, like if in the example of call we discussed, we know if the price of the contract, if the price of the stock goes up 1%, since let's assume gamma is high, let's assume gamma is 0.3 and delta is 0.6. Now we know that the dealers are going to have to buy a lot more shares in order to keep their position hedged. So we are able to like create scenarios and predict them with a good enough sort of accuracy on what the dealers might have to do. And dealers are like these are big players, so whatever they do, it's not going to have a very small impact on the market, it's going to have a substantial impact. So understanding them is important, right? Okay, so hope that's clear. Let's now see some dealer positioning. Okay, so we take in every contract that retail traders or small institutions or smart money or big sort of institutions or funds trade. Then we see the impact of that trade on dealers, and we try to chart that in the dealer Greeks build up chart. So we are looking at deltas. So this is the total deltas from all the contracts that were held by dealers at every day over the last 1 year. When the deltas are positive, then that means, since again dealers always have to hedge, when they have positive deltas, which would mean retail is either selling calls, because selling call would give retails the negative delta, but since market makers are on the opposite side, it would give them positive delta, or that would mean retail is buying puts, which again put has a negative delta. When you buy it, you get the negative delta, but the dealer gets the positive delta. So when the deltas are positive, dealers are either selling us puts or buying calls from us, and they have a positive delta. Now in order to hedge that positive delta, they have to short shares. So they have a short position in the underlying because they have positive deltas. So in any case, those positive deltas increase, they are going to have to short more, which could create a pinning effect in the market. Now in the opposite example, let's assume they have negative deltas, which could be caused by buying of calls by retail and selling of puts. When they have negative deltas, now in order to hedge them, they are buying shares. So anytime price makes a move up, and let's assume their deltas go down, they will have to buy more, which could cause not a pinning effect, a slight momentum effect. Okay, so we know that positive deltas means market makers are short the underlying shares, and negative deltas mean they are long the underlying shares, and any changes in how options are being traded and how the underlying price moves can have an effect on how they are adjusting their deltas and their underlying shares. Now let's talk about those changes. So we can see that anytime market makers were short deltas, and these are just some observations. Anytime market makers were short deltas, which means they were long shares, the price kept going up very, and that's because these sort of flow traders were mostly bullish during the uptrend that we had in 2022 and 2021. And because they were buying calls, let's assume, or they were selling puts, which would mean now these dealers are short delta, so they are buying as well. So with more call buying, they would have to buy as well, which could send the price up. But deltas alone are not enough. So at this point, let's see, all we know is that dealers are short delta, which means they have been buying shares. Now there is going to be a point where they are going to have to, let's say at this point, their contracts are expiring, they are going to dump all of their delta because they are going to dump all of their shares, which could, since again they were short deltas, long shares, and once they exit their position, that can send the price down. So during sort of all the call buying and all the bullish activity, sure, they're supporting the price, but once expiration arrives, they are going to have to dump those positions. Now the problem with just looking at deltas is that it's not enough, because we need to be able to predict the change in deltas, which would enable us to predict how dealers are going to react. And that's where gamma exposure, Vanna exposure, and charm comes in. So all of these are second order Greeks in order to find out how much is the delta going to change when gamma, which would be gamma exposure, volatility, which would be Vanna exposure, and charm, which would be time, changes. So now we are not looking at the contract price of the we are not looking at the contract price, we are actually looking at how deltas are going to change. Because if we know that at this point 1% increase in the stock price or 1% increase, let's say, in volatility is going to push the deltas down, let's say, by double, then we know that since pushing the deltas lower is going to force market makers to buy more, we might have, like, with 1% decrease in volatility, we might have a good rally here. That's interesting, because that is giving us these if-else scenarios, where as those scenarios start to happen, we can easily figure out what the market makers and dealers are doing. Okay, so that's where this gamma exposure and Vanna exposure comes in. So gamma exposure is the change in the delta with 1% move in the underlying. And one thing that has been very hard for retail traders is to actually deeply understand how gamma exposure, these Vanna exposures and charm exposures react and how they affect the market or the underlying stock. And that's the same problem with me as well. I am a data scientist, I am a software engineer, I haven't worked in a fund for 20 years, so it's hard for me to deeply understand like every single detail, but I do have a data science background. So the idea with what we have developed was is there a way to actually not have to understand every single thing that I just talked about and still figure out a way to use gamma exposure, Vanna exposure, and charm in order to understand or find or predict these moves. So for instance, with Vanna, if Vanna is negative, then that means with every 1% move up in the implied volatility or in volatility, the delta of the dealers is going to shrink by this amount, which is given to us by Vanna exposure. So let's assume now Vanna was positive. Let's assume Vanna was positive and dealers were short a bunch of shares. They were long delta, short shares. There were long deltas, short shares. Vanna was positive, which would mean any time IV decreases, their deltas were going to decrease as well, because Vanna is positive and Vanna is the change in deltas with 1% move up in the volatility. Now if IV decreases by 1% and they are short a bunch of shares and Vanna is positive, then they will have to buy back some of those shares. And when we have trending markets up and Vanna is positive and dealers are mostly short shares, then these positive Vanna effects can cause sustained and long-term rallies where price moves up little by little because these dealers are buying back all of the shorted shares that they had. So these are again just some examples on how Vanna, Gamma, or even Charm. So let's say we are near expirations and Charm is very high, which it is when contracts are about to expire, because those contracts are going to decrease in value very fast once the expiration time arrives, which causes these charm effects to magnify. But again, there are just so many pieces here, so many moving pieces, that it gets hard to understand after a point. I'm not saying we shouldn't understand them. I just went on a 10-minute sort of spree here just to talk about some of these ideas and how some of these Greeks are impacting the markets, and how we can build if-else conditions and use them to identify or predict what might happen. That's all good, but that's too much work every day. Is there a way to look at the total deltas and then couple them with Gamma, with Vanna, and with Charm to understand how market might react? That's what we are going to talk about now. And if you just go down a little bit, you're going to see some charts. The first one is the Greeks correlation. The first thing before we do that is I'd highly recommend everyone to just do a full screen here, because like these 4 charts are connected with each other. You should not be looking at these without looking at this chart. So this is the Greeks correlation. So now what this is showing is, so these values, the deltas, the gamma, the vannas, these are normalized, which means we just divide them by their max value. So they are in a small range of 1 to like about -1, -1 to 1. And so that when we are comparing these like deltas, because delta's actual value is going to be very different than gamma's actual value, so since these values are so different, we normalize them so that it's easier to chart them. Now just like know that that's what we call these normalized Greeks. Just divide the values, all the values, by the maximum value. Now let's talk about the first chart, the Greeks correlation. So what this is showing is with each normalized delta, with each of these bars, which is the normalized delta at that particular day, how did the price react the very next day? And how do I know it's the next day? Because if you look at the parameters, we are looking at 1 day's future change. Okay, so this chart is telling us that, and this yellow is where we are at right now. So this chart is telling us that anytime we have the deltas that we have today, and those deltas decreased just a little bit more, there was a lot of volatility in the market, because the 1 day moves are 1, -1, -2 at 2%, 1.5 and etc. So at this stage where we are at, this is somewhat volatile region, right? That's useful information, because we can expect the market to, let's say, be volatile or be mean reverting, things like that. But if we are just looking at volatility, then I would highly recommend just using gamma, because gamma has historically been proven to predict volatility. And you can see how beautiful this chart is. So anytime gamma is to the positive side, we can expect to see a lot of volatility. Anytime gamma, normalized gamma, is extremely negative, you can see very strict sort of changes in the underlying price. Okay, that is useful. And when I'm saying positive, it's not really positive, it's mostly like anytime gamma is very small, then we see big changes, but anytime gamma's value is just very large, then we see small changes in the underlying price. And this is just such a beautiful chart, because now if we were sitting here, like let's assume this yellow circle was sitting here, then we would know that gamma is at the very extreme end on the negative side. And with that, we can look at the past correlation and we can predict with a reasonable accuracy that tomorrow is going to be either a sort of mean reverting day, or even if we do make a trend based move, that move is going to be very, very small. Now on the flip side, let's say if this yellow circle was all the way to the right, then we can expect that there could be a lot more volatility in the market. And both of these pieces of information is very, very crucial. If you want to size big, then volatile times are the times where you size big. There is more reward, there is more risk in the market. If you are not comfortable with small move days, then you probably can predict that with this chart and stay out. That's gamma. Now, the next question is there a correlation between the gamma exposure and the actual change in price? And for that, I think 1 day change can sometimes be tricky. So let's change this to 5-day change. So now we are looking at the change in the next 5 days. And we are going back through all the historical data and seeing how things reacted. So the correlation is minus 0.043, not good. So we want something more than 0.1 in order to even look at sort of directional moves. So now based on this chart, we have the second chart. So I'll come back to this correlation, but let me just explain these two charts. Now based on where the yellow dot is, we actually look at some of the neighboring points and we draw a distribution on what happened the last time we were on a yellow bar. And this is what happened. And the 5-day move has this probability distribution. This is not a super bearish or a super bullish probability distribution. And we should not be looking at this because the correlation between GX and price changes is just too low. So this chart is meaningless here, and that is very important. If this correlation was 0.3 or minus 0.3, then this chart would be very meaningful, because we would know that the data that we are seeing here that's projected into this bar chart actually has predictive value. And correlation, as you might know, is how two things move together. So if they move together well, then we can use them to predict things. If there is no correlation, if there is no relation between them, then using this to draw this is not meaningful. So use the gamma as long as there is no correlation. Obviously, use the gamma to predict the volatility, not the direction. But let's just go to deltas again. Now deltas, this is interesting because with deltas we have a minus 0.2. Now that's a very reasonable correlation. It is very rare that you will find correlations of 0.2, minus 0.2, absolute correlations of 0.2, 0.3 and higher in the market. Anytime you do find that, stick to it and try making plays based on that. And now this delta is good because it is telling us that as the value of deltas increase, price actually tends to go down. So you can probably imagine drawing a line here that will fit this entire data set. So if you like take a sort of macro look at this chart, then this chart is actually trending slightly down. So you draw a trend line, then it won't be a straight trend line. If you're fitting, let's say, a regression line, it will be slightly to the downside. That's interesting because just looking at the deltas has given us a decent predictive power into what the price is going to do over the next 5 days. That's not that interesting because I have no idea whether this still works or not. That's what I thought as well when I built this, because there was no way to test whether this works. Do I have to wait the next 5 days in order to see whether the price actually went up? Now, because now that we have good correlations, we can use this yellow dot to anticipate what's going to happen next, and this is the distribution we get. And this distribution says there is slightly higher probability that we will go up than we will go down. That's very useful because it is much easier to deal with distributions than to deal with explicit predictions as to what might happen, because that just does not give you any flexibility. Okay, so we'll talk about volatility distribution at the very end, but these are a lot more important charts. So okay, that's good, but there is no way for me to know whether this thing works or whether I'm just like boasting off and this doesn't really work, the calculations are wrong and everything. So let's do something. Let's actually backtest. So what you can do in this chart, since these three charts are based on the data here, you can actually remove all of these bars and actually go back at some particular previous date and draw everything before that. So let's go back at maybe 17th June, which was the bottom, and let's see how these charts, how these correlations, how did the move look at that particular time, how were these price distributions, like if there is any meaningful contribution or if there is any meaningful price predictive power in these distributions, then these distributions should be bullish when we were bottoming out around 15th, 16th, 17th June. Let's do that. So this is a little bit of like brute force, where I'll have to see which like day number to enter, like how many days to go back in order to get that, and this is where we are at. So let's actually go back 2 more days probably. Okay, so this was about the bottom, right? This is where we were in terms of deltas, and we still had a correlation of we still had an absolute correlation of greater than 0.1, which was good. Now, based on the price distribution was heavily skewed towards the right, and this price change is just a range on what we are expecting. So in the next 10 days we were expecting an up to like 2 to 3% move. In the next 5 days we were expecting up to a 2 to 3% move, and the probability of a downward move was much lower than the probabilities of these higher moves. So these green bars are much bigger than these red bars. That's useful because we have seen that if you just went back and looked at this chart in mid-June, you would have seen some expectation of a move up. I'm not saying this is 100% perfect. I'm saying this gives us a distribution of what might happen, and that is very, very meaningful. Okay, let's go back a further bit more, because there was a drop right before this sort of rally or this short-term bullish market started. Let's go back 46. Okay, so this is right before the drop. Okay, now this is obviously very, very meaningful. So let's do 48. So this is where the drop, this is the very first day of the drop that was about to come in the next 5 days. Like at this point we are not seeing any future data, and how cool is it to actually be able to see that this distribution had shifted to a bearish distribution before the next 2 or 3 days, before the huge gap down in the next 3 or 4 days that happened. I think we went from 410 to 380 in the next couple of days, and we had a distribution that told us that there might be slightly more bearish momentum going forward. To me, that's magic. To you, it might be, you might not like what I'm saying, you might think it's too boring, but just the fact that we are able to use data. So like, even if you did not understand what gamma, what Vanna, what deltas are, and you just knew what we are trying to do with these correlations and how we are deriving the distribution, you don't really need to know about. Retail does not need to read every single book on volatility, on Vanna, on charm, on gamma. I think we have tried to read all those books. I have tried to read all those books, and I've tried to dumb it down in a way where it's easy for me to understand, it's easy for everyone else to understand, and we can get some distributions of what the price might do in the next couple of days. Let's see how did the next 10 days look. Okay, this is again a lot more interesting because at this point the bullish distribution just went very, very low. So now this was a slightly higher probability distribution because it's mostly just red, very little green bars, which means very little expectation for a bullish move. That's very interesting to me, and that gives me hope that this works. But I'll stop backtesting here and I'd highly recommend that you do it on your own. You can just go back any day over the last 1.5 years, and you will be able to see what happened over the next couple of days. Obviously, I'm very excited to have built this and to just talk about this in general, because this is the first time I've seen someone be able to go from these hard ideas into something that's a lot more tangible and a lot more accessible to retail traders. So I apologize if I'm not able to contain my excitement, but this is pretty cool stuff to me. Okay, so let's go back to today, and we can see now actually, like, what's most interesting is that the next 10 days correlation is very high right now, like absolute correlation minus 0.3, minus 0.28, and that correlation is telling us that there is a higher probability of a move up in the next coming days than there is for a move down. But if you go to the 1-day chart, you'll actually see that there is a slightly higher probability of a move down, just like on Monday, maybe like midway through the day, maybe by Monday end. And so this is like useful, because what we can get out of this is that although there might be some bearish momentum on Monday, overall, just looking at these Greeks, or we're just talking about deltas right now, just looking at historical deltas and how price moved one day by one day, we do expect some bearish move on Monday, but overall the next 1 or 2 weeks we might actually keep going up. Sure, there could be like a couple of small dips, but just based on this, the expectation is that we might go up. Now, the problem with looking at 1-day moves is you should be able to spot this right away. When you're looking at 1-day moves, these correlations decrease significantly. So the predictive power is not as strong as when you're looking at these 5-day or 10-day moves. So just keep that in mind. Like, if this doesn't pan out, know that 1 days do have a slightly lower correlation. So sometimes these errors are expected, and this is a distribution. So there is a 35% probability of a negative move, 0 to let's say minus 0.6%. There is not 100% probability. So that's where I think distributions come in. If this was like 90% probability and green was like 10% probability, then we would go much bigger in size with, let's say, puts, or we would short with a big size. But this just tells us there is a slightly more, there is slightly higher probability for a bearish move on Monday. So hope that's useful, but delta isn't the only thing we have. Is there a way we can increase this correlation by using a conjunction of deltas and add maybe Vannas on top, or maybe charm on top, maybe even gamma on top, and see if we can increase this correlation? So you, as a retail trader, what you should be doing is try out all of these Greeks and see if there is a way to increase, absolutely increase. Like minus 0.2 is much better than minus 0.1. So we are looking at absolute delta right now. See if there is a way to increase this, because the more you can increase the correlation, the more we can expect that there might be some predictive power in the distribution. So we when we clicked on Vanna, we went from minus 0.8 to minus 0.08 to minus 0. Almost 1, which is much better than minus 0.08. And so the distribution now looks slightly sort of balanced out, which means we are not fully certain about a direction just on 1 day. Let's look at the direction again for 10 days. And again, the 10-day direction is still leaning towards the bullish side. So 10-day, just based on just the deltas and the deltas plus Vannas, do show us that we are expecting a little bit of a move higher as well. Obviously, this chart is going to change, because these delta plus Vanna can go from this yellow dot all the way to this yellow dot. Like, it can change significantly when new flows come in every day. So you need to be able to look at these distributions every day to see how they are changing. This is where we stand right now. But if this yellow dot changes, then we are going to have a completely different distribution for the next 10 days. But given where we are at right now, we are expecting a price increase. Then you can also, so minus 0.26, still good. This decrease, so let's just skip this. And so it looks like just looking at deltas or delta and Vanna, gives us the best correlation. So just stick with those. With individual names, sometimes you might also see gamma. Sometimes charm might also work really well. The different thing we are doing here is we are mining data to come to different conclusions. What most funds and people who have worked in the industry for 30 years do is they have their inherent sort of bias that they believe in, and they have a lot more sort of they have a lot more experience working with these data sets. But since we don't, but we still want to use them, we still want to make money, we still want to be able to predict things, we have taken a slightly more data driven approach where we are mining data to find correlations, to find predictive power, and we are using that. So that's a limitation that we have. Please be aware of that. I am not an expert. I've only been in markets for about 4 to 5 years, but I think like what we have developed here is a really good alternative to what other funds are able to do. And so I'm going to stop here and sort of stop talking about dealer positioning. I hope I don't want to go too long, but I hope just sort of me talking about some of these things has given you an idea on how to navigate some of these charts. We will explore them and place based on them. We will be playing with these for the next couple of years at least. So, and these will keep changing. So by the time you're watching this video and some of these things have changed, we have introduced a couple of new Greeks, a couple of new things. We are able to improve these correlations a little bit more. Some of these charts are slightly changed. Just understand the basic idea and just know like how some of these things are working, and you should be fine. But we obviously, since we are just sort of adding these things up, we might change them just a little bit to make it one more predictive and be able to sort of help us and help other retail traders. So that's it about the dealers build up. And these positions are obviously, so at this point, this is an aggregate of everything that the dealer has in terms of deltas and Vanna. But sometimes we want to actually look at how is the dealer positioning for each strike and for each expiration, and then we can dive deeper into what's happening on the dealer side. And that's what this dealer positioning and Vanna charm flows by expiration and by strike show you. So we can see that dealers were short a lot of deltas in the last expiration, which was Friday, which meant they had to they bought a lot of, so they were short delta, so they bought a lot of shares, which is why you can actually see that although we made a move up, it was a very, very slow move because there was just not enough freedom in the market to actually move higher. So we like grinded up almost all day. Then we can see that we do have more negative delta on 19th August as well, which means dealers are sitting on long positions right now. So we'll see how that works. And then once we go forward, we can see delta slightly switching to positive, which would mean now dealers are going short shares. Anytime Vanna is positive, which means like if the volatility decreases a further bit, then dealers, if they're short shares, they'll have to buy back. If they're long shares, they'll have to sell. So it creates a slight pinning effect or not enough volatility. But if like, let's say Vanna becomes negative and increase in volatility is actually decreasing delta, then we might see some volatile markets in the next couple of months. But just I think instead of me saying what might happen, look at this chart, look at like the 10-day changes, see what the gamma says, because again we use this for volatility, and we can see that we are not expecting a lot of volatility right now, but if this starts moving to the right, then we would definitely be expecting more volatility. So just keep an eye on this. I think this chart actually summarizes everything else we are talking about in terms of volatility, but then looking at deltas and Vanna in order to predict the direction actually helps as well. So one thing that's useful here is a lot of people, and this is a very important point, a lot of people use open interest to gauge call walls, put walls, highest strike where calls are sitting, highest strike where puts are sitting. And there is a very big inherent limitation in that, because open interest constitutes of both sold and bought positions. So if there is an open interest of 1000 contracts, there is no way to tell just looking at open interest whether those 1000 contracts are bought or sold. And so when you are looking at a high open interest in calls and you're saying this is very bullish, that's completely wrong. Like there is this notion of looking at a call open interest and thinking this is extremely bullish that I was a victim of not too long ago, which is completely wrong. You need to be able to tell how much of that open interest is actually bought positions versus sold positions, because if all that the call open interest is sold positions, then that's a bearish sign, not a bullish sign, not a bullish sign at all. A much better way to look at open interest is actually to look at dealer positioning for each strike, because retail is sitting at the exact opposite of these positionings, because dealers are taking the opposite positions of us. And this is a lot more meaningful. If you want to build call walls, put walls, if you want to deal with open interest, skip the open interest chart that we have on the top. This is just raw open interest, and actually look at this dealer positioning and dealer open interest, I'd say. And this is a lot more meaningful. And we can see like dealers till about 430 are sitting on huge sort of short deltas, which means they are sitting on big bought positions. And as we go after that, then these sort of negative deltas start to decrease and positive deltas increase. You can actually filter this by expiration. So let's see what's happening on September. Now this is very interesting, because we were seeing that the dealers are sitting on negative deltas for August 18th or 19th, but for September now they're starting to get positive deltas, which means they are short shares. So again, useful information if you want to dive deep. Otherwise, just stick with the charts above. And we can do the same thing for Vanna and Charm. So this is Charm. I can select Vanna here. I can filter it by strike, and we can actually see where we are sitting on positive Vanna and where we are sitting on negative Vanna. I won't go into too many details on how do you use this to build support and resistance levels. That's a topic that I love to explore in some other video. And then we have the gamma exposure profile and the Jack's gamma exposure by expiration. I'd highly recommend just skipping these two charts. If you really want to sort of build support and resistance levels, then looking at the extreme levels on the gamma exposure chart can actually help you find important levels of interest. And this is something that we already use. So just pick the, if you're a day trader, just pick the top, the most bullish, the most bearish bar, and plot them as horizontal lines, and they act as good support and resistance levels. Why? Again, that's a topic for another video. I will go into why does these lines act as support and resistance levels, but I think this video is already long enough. The goal was to actually convey what we are doing with the dealer positioning chart, because I think this is the crux of everything that retail is able to do. And I'd love to do more, study more, read more, and be able to become a slightly better expert, not an expert, but slightly better in slightly have better knowledge. But what I have right now, I've spent all my effort in using that to build this. I hope this is useful for you. Let me know if you have any comments, questions, feedback, anything in the comments. And thanks again for watching the video. I know with my accent and everything, sometimes understanding me can be hard, and please know that I know that, but the entire knowledge that I used to sort of build these, that's in my mind, so I have to create this video. So thanks again for watching this. Thanks again for all your support. I'll see you guys around.